Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Vanda Pharmaceuticals.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, let's just jump right into this, because if you've been watching the ticker for Vanda earlier this month,
Specifically around February 11th, yeah.
right, February 11th, you did not see a normal stock chart. You saw what looked like an absolute crime scene.
It was ugly. There's absolutely no sugarcoating that price action.
A nearly 10% drop immediately following their earnings report. And for anyone just casually observing, the narrative basically writes itself, right? Earnings a miss, stock drops, the company is in trouble, it just looks like a sinking ship. But you're actually arguing that the market has fundamentally misread the room here.
I am, yeah. I'm arguing that if you only look at that earnings drop, you're looking at history, you're not looking at the future. It's a classic case of informational asymmetry.
Right.
The market saw a backward-looking accounting miss and just slammed the panic button. But they completely missed the forward-looking coiled spring.
Coiled spring. That implies a lot of tension, potential energy just waiting to snap.
Exactly. While the price was getting pushed down by bearish sentiment and algos just reacting to headlines, the fundamentals, specifically the regulatory calendar, were winding up. And the reason we are doing this analysis today, literally today, February 21st, 2026, is because that spring is uncoiling right now.
Because of the catalyst.
Because of the catalyst.
Yeah.
There is a massive event happening today. We are talking about the FDA decision deadline, the PDUFA date for their drug Bysanti.
And for those listening who might not follow biotech on a daily basis, PDUFA dates are usually high drama.
Oh, they're the Super Bowl for this industry. It is entirely binary. You win or you lose.
Yeah.
And we have already seen the market tipping its hand a bit. Just look at the reaction to the approval headlines recently. We saw a 44% surge in after-hours trading.
44%? That is wild.
It's massive. And it signals that the market is finally waking up to what is actually happening under the hood. So our job right now isn't just to do a post-mortem on a messy earnings report from a few weeks ago.
Right.
We need to figure out if this company is pivoting, as we speak, from being oversold to a full-on breakout.
I do love a good turnaround story, but I have to play the skeptic for a second. Before we get too carried away with 44% surges and, Super Bowl analogies, I want to pump the brakes.
Yeah.
Let's look at the actual financials. Because promises of future blockbuster drugs are great, but what is paying the electric bill right now?
That is the right question to ask.
Is there a real business here, or is this just another science project burning through cash?
You can't survive on hype. Eventually you have to pay the rent. And with Vanda, the core engine keeping the lights on is a drug called Fanapt.
Fanapt.
Okay.
And that's their treatment for schizophrenia and bipolar disorder, right?
Right. Correct. Schizophrenia and bipolar I disorder. Now, typically, when you look at a drug that has been on the market for a while, you expect the sales to be steady, maybe a little flat. They become cash cows, but they aren't your growth engine.
Right, they just chug along.
But Fanapt is behaving like a growth stock. In 2025, net product sales for Fanapt didn't flatline. They grew 24% to $117.3 million.
24% growth for an established drug. That's pretty impressive. But let me ask you, is that real growth? Or did they just hike the price? Are they charging more for the exact same amount of pills?
That is exactly what the cynic would assume, and honestly, usually you'd be right. But here, the volume completely backs it up. Total prescriptions were up 28%.
Oh, wow.
Yeah. But here is the number that really jumped out, and if you're listening, keep this metric in mind because it is the entire key to the bull thesis on their current revenue. New-to-brand prescriptions surged 149%.
Wait, hold on. 149%.
Yeah.
That's not a rounding error. That is more than double. That implies something drastically changed in their approach.
It does. New-to-brand is your leading indicator. It means doctors aren't just automatically refilling scripts for patients who have been on it for years. They are actively putting new patients on this drug at a rapidly accelerating rate.
So why is that happening? Did the drug suddenly get trendy? Did they tweak the formula, or are they just marketing it much more aggressively?
They are shouting much louder, and they're shouting in a lot more places. It is not an accident. It's a very specific and very expensive strategy. In 2024, Vanda made a huge operational bet. They expanded their sales force massively. They went from 50 representatives up to 300.
Okay, let's pause on that. 50 people to 300. That is a six-fold increase. That sounds like a logistical nightmare.
It is a massive undertaking.
And highly expensive. You don't just hire 250 people, train them, Give them laptops and company cars and send them into the field for free.
You absolutely do not. And that is where the risk lies. That is a huge injection of fixed costs. If you hire that many people and the sales don't immediately follow, you burn cash fast. You bleed out.
Right.
But what we are seeing with that 149% surge in new prescriptions is that the bet is actually paying off. That operational efficiency is clicking into gear.
So the Army is in the field and they're actually taking territory.
Exactly. And that early success gives management the confidence to issue their current guidance. That sales force expansion is the main driver behind their 2026 revenue guidance, which they pegged at $230 to $260 million. They aren't just hoping for those numbers. They have 300 people on the ground making sure they happen.
Okay. So the core engine is running hot, FanApt is growing, the team is executing, even if it costs them a pretty penny to scale up. But let's pivot back to the main event we teased at the top of the show. Today is the PDUFA date for Bysanti.
The big day.
Why does this specific drug matter so much? I mean, is it just another pill in their lineup? Why should the market care about Bysanti or, I guess, milsaperidone to be technical more than any other launch?
It is a game changer because of one word: duration.
Duration.
In the biotech space, your absolute biggest enemy is time. You live and die by the patent cliff. Normally, by the time a drug finally gets approved, ramps up, and becomes popular, you have maybe 5, maybe 7, if you're lucky, 10 years before the generics swoop in and wipe out your margins.
Right. The knockoffs flood the market and the cash party is basically over.
Exactly. Bysanti is different. It has been granted new chemical entity status.
And what does that mean in plain English for the listener?
It means the regulators recognize it as a completely distinct novel active ingredient. And critically, when you combine that status with their existing patent estate, Bysanti has patents running all the way out to 2044.
2044. That's almost 20 years from now. My kid will be out of college by the time that patent expires.
Exactly. That is a lifetime in this market. Think about the pure cash flow implications there. This creates an absolute shield against generics in the bipolar I and schizophrenia market for a generation. It's a long-term cash flow moat that very few biotech companies can ever claim.
That is massive. Usually you see investors sweating bullets about a patent cliff just 3 or 4 years out. 2 decades of runway is incredibly rare.
It is, and it's not just about the timeline. It's about the sheer size of the market opportunity. We mentioned the initial approval target is bipolar I and schizophrenia, which is already a huge market. But there is a second layer to this value proposition that I think the street is currently underpricing.
What's the hidden layer?
Major depressive disorder, or MDD. They are expecting phase 3 data for using Bysanti as an adjunct treatment for MDD by the end of this year, 2026.
And the market for depression treatments is significantly larger than schizophrenia, right?
Right.
It's much larger. We are talking about an order of magnitude difference in the patient population. If that phase 3 data comes back positive, it effectively doubles the addressable market for the drug overnight. So when you see that 44% stock surge we talked about earlier, the market isn't just reacting to today's news.
Well, they're pricing in the future.
Yes. They're realizing this company holds a highly protected asset that could dominate multiple massive indications for the next 20 years. It's a complete repricing of their long-term value.
It is really starting to make sense why the smart money might be treating this recent dip as a prime buying opportunity. But Vanda isn't just FanApt and Bysanti, right? I want to make sure we aren't staring at a one-trick pony. If Bysanti were to fail today, is the whole company done for?
No, and that's a crucial part of the bull thesis. They have built a highly diversified pipeline to mitigate that exact binary risk.
I was actually looking at their pipeline list, and one name really stood out to me, Nereus. Mostly because the indication sounds completely different from everything else we've been talking about. Motion-induced vomiting.
It is a bit of a left turn, isn't it? But that is actually a good thing. Diversification reduces your correlation risk. Nereus isn't some distant pipe dream either. It's a regulatory win that is happening right now.
So this isn't a check back in 5 years science experiment.
No, this is imminent. The commercial launch is slated for late Q2 or early Q3 of this very year. We are talking a matter of months.
Okay, so that is immediate new revenue coming online.
Exactly. And analysts are already starting to model potential upward revisions to their revenue estimates based on this specific launch. It's a niche market, sure, people getting seasick or carsick, but it's a brand new revenue stream activating almost immediately.
And then there's another one in the mix, imsidolimab.
You got it. Imsidolimab. This is a treatment for generalized pustular psoriasis. It's an autoimmune condition, which again is very different from the mental health focus of Fanapt and Bysanti.
And where are they with that one? Is it close to crossing the finish line?
The BLA, the Biologics License Application Submission, is the next key milestone. And what I absolutely love about this part of the story is how it's being funded. Remember that cash flow from Fanapt we were just praising?
The 24% growth engine.
Yes. That operating cash is directly funding this BLA submission. They aren't going out to the market and diluting shareholders to keep the lights on for this research. Fanapt pays for imsidolimab. And if it gets approved, this drug offers exclusivity all the way into the late 2030s.
So you have Bysanti protected until 2044 and imsidolimab protected into the late 2030s.
Correct.
That is a very robust long-term intellectual property picture.
And just to summarize the sheer volume of activity happening here, Vanda is planning to have 6 commercial products on the market by the end of 2026. 6. And they are funding these launches primarily with their own internal cash flow. That is an incredibly rare position to be in for a biotech company of this size.
Okay, you are painting a very, very rosy picture here. Double-digit growth, long-dated patents, rapid product launches, 20-year runways. But I have to play devil's advocate here. I have to be the skeptic in the room because the stock chart does not lie.
Please do.
If everything is executing so perfectly, why did the stock drop nearly 10% earlier this month? Why were the financial headlines so brutally bearish? You don't drop 10% in a day if everything is flawless.
No, you don't. And we absolutely have to unpack that because it provides essential context. That drop was a direct reaction to the Q4 2025 earnings report. And frankly, if you just glance at the headline numbers, it was a miss.
How bad of a miss are we talking?
It wasn't pretty. Q4 sales came in at $57.2 million versus the consensus estimate of $59.3 million, so a top-line revenue miss. But the earnings per share, the EPS, was the real stinger. They reported a loss of $2.39 per share.
Ouch. A loss of $2.39.
Versus an expected loss of just $1.32.
Yeah. That is nearly double the expected loss. That's a massive deviation from the estimates. Why? What actually happened there? Did they just lose a suitcase full of money?
No lost suitcases, thankfully. But their margins were heavily pressured. And the reason ties directly back to what we were praising them for 5 minutes ago. The sales force expansion.
Ah, the 300 reps.
Exactly. This is where the rubber meets the road. Hiring 250 brand new people is incredibly expensive. Training them is expensive. Putting them out in the field with expense accounts is expensive. All of that hits the operating expenses line on the income statement immediately.
So the loss isn't money vanishing into thin air. It's money being paid out in salaries and infrastructure.
Precisely. On top of that, they had a one-time non-cash tax charge that made the GAAP numbers look significantly worse than the actual underlying business performance. But that tax charge is just accounting. It doesn't impact their actual day-to-day ability to operate.
So the massive loss was basically a combination of accounting gymnastics and a heavy upfront investment in their own future.
Yes. And then, to add insult to injury for the short-term traders, the guidance for 2026, that 230 to 260 million range, came in slightly below the street estimate, which is sitting at 271 million.
Let me get this straight. They missed on earnings, they missed on revenue, and they guided lower than the street wanted.
In a strict vacuum, yes, that sounds terrible.
So the market effectively punished them for spending their own money to grow their business.
That is exactly what happened. The market saw widening GAAP net losses, got spooked, and sold off. But this is exactly where critical thinking pays off for an investor. A savvy investor looks at that exact same earnings report and sees something completely different. They see the necessary cost of launching a massive portfolio. You simply cannot launch 6 products and triple your sales force for free.
Right. It's the classic short-term, pain for long-term gain scenario.
Precisely. The market is incredibly myopic. It just sees the expense line going up this quarter. It doesn't necessarily calculate the 20-year protected revenue stream from Bysanti that those specific expenses are securing. The market hates uncertainty, and it hates aggressive spending. Vanda is doing both right now to secure the next decade of dominance.
So knowing all of that, the good metrics, the bad headlines, the ugly chart, where does the stock actually stand right now in terms of valuation? Is it a genuine bargain or is it a value trap?
I strongly believe the data points to a massive discount. Right now, Vanda is trading at roughly 1.4 times sales.
1.4 times sales. Can you put that in context? Is that highly unusual?
For a biotech company with approved growing products, it is practically unheard of. Usually you see multiples of 3, 4, even 5 times sales for companies with this kind of growth profile and IP protection.
So a 1.4 multiple is basically.
It is pricing in total failure. It's pricing in a doomsday scenario where the new drugs don't sell, the pipeline completely fails, and the company shrinks into irrelevance.
But we already know things are going right. We know Fanapt prescriptions are up 149%.
Exactly. And that blatant mismatch between reality and valuation is what creates the opportunity for you. Despite the bearish news cycle surrounding that earnings miss, analysts are projecting huge upside. We are seeing average projections of around 125% upside, specifically tied to these regulatory decisions happening right now.
125% upside.
That's
That is substantial. It sounds like a highly asymmetric bet.
It is. But we have to remain balanced. We can't just stare at the upside potential. We have to clearly define the risks.
Right. Summarize the risk profile for me. What is the nightmare scenario that keeps you up at night with this play?
The biggest risk in biotech is always regulatory. PDUFA delays are a constant threat until the ink is literally dry on the approval. Even with a target date of today, things can inexplicably get pushed back. If Bysanti hits a snag or gets a complete response letter instead of an outright approval, the stock will get punished severely.
Right. If the FDA says no, the entire 20-year moat thesis breaks down.
Exactly. Then on the commercial side, you have generic pressure mounting on their older drug, Hetlioz. That is a slowly declining revenue stream that they urgently have to replace with these new launches. And finally, the cash burn itself. R&D is notoriously expensive. If they don't grow Fanapt revenue fast enough to cover those 300 new sales reps, they might have to raise cash.
Which means dilution.
Which means issuing more shares and diluting the current equity holders. That is the race they are currently running. Can they grow sales fast enough to pay for the massive sales force they just hired?
So it is absolutely not a risk-free bet.
No stock ever is. But look at the potential rewards on the other side of the scale. You have a multi-decade moat with Bysanti. You have immediate double-digit revenue growth from Fanapt. And you have a valuation multiple that, as I said, currently prices in failure rather than success. The asymmetry here, the massive potential upside versus the already priced-in downside, is very compelling.
It really feels like a distinct pivot point in the company's history. Okay, let's bring this all together for everyone listening. We have a company showing 24% growth in its lead product. We have a massive patent shield unlocking literally today. And it's trading at a deep, deep discount because of a messy quarter that was mostly messy because they were aggressively hiring people to sell more of their drugs.
I think that is the perfect summary of the situation.
So what is the final verdict?
For me, it's a strong buy based on a catalyst-driven re-rating. The broader market has been looking backward at that earnings miss. It urgently needs to look forward to the Bysanti approval and the upcoming pipeline launches. My target horizon here would be swinging this into the Q2 launches, riding the momentum of Nereus and the Bysanti news, or, frankly, just holding it for the long-term intellectual property portfolio. If you believe in that 20-year moat, you hold it. If you just want to play the market mispricing, you look at the next few months.
Either way, it looks like the roller coaster is finally heading up that first big hill.
It certainly does. And considering the trading volume we're seeing, it is going to be a very exciting ride.
Well, I'll certainly be glued to the ticker today. It makes you wonder, what if the real innovation in biotech right now isn't just happening in the lab, but in the willingness to spend aggressively like a tech company to completely dominate a market? Something to think about. That's it for today's analysis of Vanda. Thanks for listening.